Okay, so read this disclaimer first, please, guys. The clue's in the name of the channel. I'm an amateur, and I'm actually pretty bad. So nothing in this video should be taken as financial advice. Don't act on anything. There could well be errors. There could be slips of the tongue. Anything. Do your own research. Seek your own professional advice. Don't listen to me. Hello there, guys. So I've already tried to make this video once, and my God, it was waffly, and I repeated myself a million times. So I'm going to try again, but I wouldn't be surprised if it ended up a bit like that again this time as well. Right, so as the title of the video says, I'm going to go through one part of my portfolio, which is the blue part, which I don't know, what would you, I suppose I'd call it the core part. It's stuff that actually, at some point, the pink stuff here will actually just end up going into this stuff. This is the kind of stuff that I want to hold in the longer term. And it makes up this is a percentage by value, this column. So the core makes up, if we go to the bottom right here, you can see the sum is 80.9% of the portfolio. Well, from Friday the 22nd of November anyway. And you'll notice that it's all collective investments. So they pool the money together and buy lots of different investments. So not if one company dies, it doesn't completely wipe out any of these investments. And you'll notice also that most of them, so these ones, that one, they're all investment trusts, with the exception of one index tracking ETF, exchange traded fund, which tracks the FTSE 250, so the mid-cap UK companies. And there is 3 open-ended funds, what are they called, OEICs, there's acronyms for them, UCITS and OEICs. I don't know I don't know the difference between them, but they're open-ended. That's how I see them. Woodford Equity Income, Fundsmith, and Marlborough Multicap. I prefer investment trusts. I'll just explain why I prefer investment trusts, because, as I've mentioned, I'm living off the income of this portfolio, and which is there. It's a little bit short. I need 14 grand a year, so I need some of the growth stuff to work for me, for it to work out. And when it comes to income, they have the facility to hold back 15% a year of their income. So in this example, this is City of London's last 5 years' income. In this example, it shows here that a thing called dividend cover. And what basically 1.06 means is, if let's say the company's revenue from dividends of all of the companies it holds, the assets it holds, say if their revenue was 106 in that year, they've actually only given us 100 in the dividend. So actually the revenue per share, so the dividend was 18.6, but actually they would have received 1.06 multiplied by 18.6. That is how much revenue from the assets they would have got. So they would have put the rest into a revenue reserve for the bad times where they might not get as much dividend. So you can see that as in Murray International here, you can see it happening, because if I click onto that, which summarises it per year, you can see the number goes below 1 here, here, and here. So it helps them smooth out the income, and it keeps increasing their income. And also you'll notice that it gives them kind of long dividend records, consistency like that. This is City of London's dividend level, and the percentage it's increased each year. And it's gone for about, I think that's the record holder, with about over 50 years of dividend increases. And in the main, overall, they do better than inflation. Here's RPI for each year. And overall, so I've gone from 2005 to 2018 here. RPI is up 46%. City of London's dividend is up 105%. So you're not losing purchasing power like because of inflation, because it's beating inflation. And even the FTSE 100 beats inflation, 46%, 76% from 2005 to 2018. So I mean, so you don't even need to really beat the market. You could just track the market, but then you get years like this where your income reduces. But then you also get years like that where it jumps up. So you get a few more of the big jump ups, but you get fewer of the reductions. Well, in City of London's case, you don't get any reductions, so it's just a more consistent, and overall, you compare the two numbers, 105% up, 76%. Overall, it's beating the market in terms of dividend increases. And in this case, it generally has a higher yield anyway. Generally, obviously, it fluctuates as the share price and the index fluctuates. And also, the big thing about another big thing about investment trusts is they have a fixed pool of capital. Is it? Sometimes I'll get the words wrong because I'm no expert, as my disclaimer says. They have a fixed pool of assets. So if somebody who owns a investment trust doesn't like it anymore and they want to get rid of it, they sell it to another human being, or well, it doesn't have to be human, does it? They sell it to another person. Whereas with open-ended funds, like Fundsmith and Marlborough Multicap and Woodford, they would have to ask the fund manager to give them the money back. And what that means is the fund manager then has to sell assets to give you your money back, which in some circumstances makes it harder for them to manage the money, because they, at some points, they might have to sell assets that they don't want to really sell. And that was a big issue with Woodford. Loads of people wanted the money back when he started to do badly, and it just exacerbated his poor performance. And he had to sell loads of assets, but because he had loads of assets that were hard to sell, he ended up having to sell his good assets. So it just made the portfolio worse and worse. And me being kind of stubborn and kind of always wanting to hold and hold and hold through bad times, I just stuck with it, and it's been a disaster. Anyway, because the price of the investment trust is determined by the market, i.e. how much someone's willing to pay for it, how much someone's willing to sell it for, the price of the investment trust can actually fluctuate independently somewhat to the net asset value, so the value of the assets the investment trust holds per share. So as you can see here, the blue line is the share price, the purpley pink line is the net asset value, and as you can see, it tracks it a bit, but it's not perfect. As you can see here, this is the premium or the discount, they call it. So if the share price is higher than the net asset value, this number is positive, and the reverse as well. So as you can see, the premium and the discount fluctuates. So in the midst of the financial crisis, it was at a -2 because sentiment was bad, but then it recovered, and since then it's been generally positive apart from here. I think that's where the market got scared about China's growth prospects, I think, here, and the whole market went down. As you can see, it spikes down there, the net asset value does. For some reason, the share price doesn't seem to go down. I don't know if that's something to do with how it's plotted. I don't know, maybe in this plot some of the data got missed out, perhaps, because really, to match that, the blue line should be going below the purple line here, shouldn't it? I think that's just a data issue and the way it gets plotted on this Hargreaves Lansdown website. So that's that. Even though, so to make, they get a fixed pool of capital, which makes the investment better. The downside of that is you don't always get what you pay. When you sell it, you might not always get what you deserve. So you might need the money here, but you might have to put up with losing 2% compared to the value of the assets. So that's the downside of having a fixed pool of assets for the fund manager. But since I'm investing for income and I don't really plan on ever selling, this suits me fine. It also means that occasionally you can see a discount and jump on it and get a bargain. But they also boost their performance, but also boost their downside as well by having gearing if they want to. So if you see there, City of London's got 9% gearing, so they've borrowed money to invest. But like I say, that boosts your returns in good years, but in bad years it boosts your losses. Right, what's next? Growth versus income. Right. So as you can see in my kind of portfolio overview kind of spreadsheet. Right, so as you can see, some of these have high dividends, like 4.5%, sorry, dividend yield. This is 5.5868%. This is the dividend yield on the price that I got on Friday the 22nd. But then other ones have low dividends, about circa 2%. and then in between 3%, and then even higher 6%. So as you can see here, the overall dividend yield of my portfolio is 3.46%. I could go to like 4.5%. As you can see, City of London's 4.5% at the moment. I could just have it all in similar things to that, and I would be fine. But it's less diversified, that is. Things like Fundsmith and Scottish Mortgage, they're just all out growth. And in this market environment for the past 10 years, things like this have done way better in total return than things like this. Because even though they've got lower yields, their capital growth has just been phenomenal over the past few years. So I don't want to have everything in there, but I am kind of limited. In my mind, I need the income to spend. So as you can tell, it's a lot more dividend stuff than it is growthy stuff. So if I highlight the stuff that I consider more dividend focused, so Finsbury and BlackRock are kind of dividend. They're really more growth because obviously the dividend is low, but in BlackRock's case, it's growing quite fast. So that's kind of dividendy, 3%. Definitely dividendy, definitely dividendy. Definitely not, definitely not. Probably not. 1.82 is quite low. Multi-Marlborough cap. So all of those I consider to be kind of dividend ones rather than growth. And actually, to get a full picture, we really need to look at the other stuff that I'm not supposed to be talking about today. These are all high dividend stuff. So at the moment, I've got about 62.7% in really high dividend paying stuff, and the remainder 37.3 in growth stuff, which I think is a decent balance considering I need the income to live off. I think if I was in my accumulation phase of my portfolio, now I was trying to grow the capital before I retired, I would probably go, I don't know, maybe 50-50 and have a few more of the growthy things and a bit less of the high dividend stuff. Anyway, right, growth versus income, done that. Right, so let's just go quickly through each one. The first one, Woodford Equity Income, open-ended trust. Look at this, year by year, awful. But then this is the kind of thing that puts you off. At the beginning, it did quite well, and he's done quite well over his whole career. This is the thing, past performance doesn't necessarily mean future performance, does it? Anyway, I've talked about that a lot. It's UK focused, lots of small caps that did not do well. Second in line is City of London. As I say, it's a very famous trust, a longest dividend record of increases. It's UK focused, mainly large caps. Murray International, similar to City of London, but international. So it's big companies that pay big dividends, but it's spread geographically. United States, Taiwan. I think at the moment Bruce Stout is in a lot of emerging markets actually. But I like this because it's someone else is choosing where the geography goes, whereas other ones, well, I'll tell you in a minute. So Lowland Investment Company, that is another UK-based one, but it has more of a mid-cap, possibly smaller cap. I'm not quite sure. So it has quite a lot of smaller companies compared to City of London, but it also has large companies. So it's kind of a multi-cap, I suppose, but it's UK focused. Finsbury, this is a UK focused one, but it's all growth shares. So they'll all have quite low dividends and they grow. So yeah, mainly UK. Even if they're classed as a UK trust or fund, they'll normally have a remit to have like a low proportion in foreign countries as well. But look at Finsbury's, look at that performance over the last 10 years, about 200 to almost 900, and it's kind of straight up as well. Well, a bit of a dip there, but yeah, it's a great performer. This is what I worry about though. I worry that things that have been working well in the past 10 years, at some point maybe that'll turn around. That's why I'm wary of it. I mean, to my detriment really. I've not fully gone in on things that have been doing well recently. I've got a lot of stuff that's kind of plodded along recently instead, or done really badly, like Woodford. BlackRock smaller companies. It used to be called BlackRock UK smaller companies. I've noticed this, and it seems to me that they've changed the remit. It's done very, very well over the past 10 years. Below 500 to tripled in 10 years. So I noticed they changed the name, and then I have a check here. it's now only 66% in UK companies, smaller companies. So it seems to me they've changed the remit, which I kind of like, because I think this is part of why I've underperformed since I've been doing this, is partially because I've got too much UK stuff. So I'm kind of happy that they seem to have changed the remit. They didn't seem to advertise it very much though, because I check all the, I always look out for news on my holdings, and I never really noticed anything where they said they were going to start spreading their wings into other geographies. But I don't mind that they're doing it. But look, this one has a phenomenal dividend increase record recently. Look at this. Well, way back until 2012, it's been doing about 20% a year increases. Look at that, from 2005 to 2019, it's gone up by 590%. The dividend has, and I think, I mean, the share price has done pretty damn well as well. So that's a pretty good one at the moment. But you know, I think actually this could be coming to an end now, because the latest dividend increase was only about 7%, and they've just had a manager change as well, which kind of worries me. I don't know. I'm not quite sure what I do when these managers change. So far I'm holding on, but like Lowland is another one. It's run by James Henderson for the past 20 odd years. Very old guy. Well, not very old, but you know, it's someone who is nearer the end of his career than the beginning. And in the past few years, he's had a co-manager called Laura Fole, who's very young. And it makes me wonder, this seems like a transition period to me. It seems like Steve McLaren and Sven-Göran Eriksson. And look how that turned out. So who knows? Maybe I'm being sexist. I don't know. Subconsciously. I don't know. Anyway. What's next? Vanguard. So this is just a FTSE tracker that tracks the FTSE 250. So the 101st to the 350th biggest companies in the UK stock market. Obviously this changes all the time, because companies get promoted to the FTSE 100 and they get demoted down here. But that's been pretty good. Some good dividend increases. Up 160% over that 2005 to 2018 period. But again, it's not an investment trust, so it has days like this where it goes down by quite a bit. Down by a bit last year actually, because you can't manage. There's no manager who kind of manages the dividend levels. And Henderson Far East Income, as the name suggests, really mainly Asian high yielding. I think they do some, I forget the words, they do some kind of optiony thing where they sell puts, is it? No, ignore that, it's the wrong wording, I've forgotten the wording. But basically it's not all dividends that they pay out to us. But I mean, they've had a pretty good record though. And this period for Asia, this period covers quite a down period that the market's had. So if you look at the share price over the past 10 years, there was this period here, which is kind of why you'll notice a lot of my Asian or emerging market ones are actually up quite a lot. So the Asian one, the emerging market one, is up 28%, up 43% for the JP Morgan Global Emerging Markets, and Henderson Far East Income up about 9%. But you kind of expect that because it's got such a high yield. So Aberdeen Asian for smaller companies actually reduced its dividend in that period, but this Henderson Far East Income one kept going with the dividend increases and even had dividend cover. So it did quite well in that torrid period for the region. JP Morgan Global Emerging Markets Income, pretty much as the name says, it's emerging markets income. But it's a bit lackluster in terms of dividend increases. Look at this. Same. Up a tiny bit. What is it? I think it's only the past 2 years, I think it's just gone up by 2% or something. After a good few, about 2% a year, after a good few years of not increasing at all. So it's kind of on my naughty step, pending a decision, to be honest. Fundsmith Equity, excellent performer, very famous investor. Is he too famous? Could this become, in X number of years' time, could this become the next Woodford? And he falls off the rails. I'm hoping not, because actually he's been his own boss since the beginning in 2011. That's the other thing. He hasn't been through a downturn like the the Great Recession or whatever it was called recently. But because Woodford left his company, who might have been kind of shackling him in a bit, and then when he was free to do what he wanted because it was his own company, he fell foul. So, but Fundsmith has always been his own boss since 2011, and he's done very well. I'm also not quite as worried about the open-ended fundness of it, because if lots of people wanted to leave this fund and ask for their money back, they are mainly really big companies, Facebook, Microsoft. In fact, I think he talks about it in some of in his yearly like little conferences they have where they tell us about what's going on. And they're all really big companies, and he estimates that he doesn't hold a big enough portion of those companies to have a big effect on the share price if he started selling them. Hopefully, I hope he's right, but it's another one that I kind of not sure if I'm going to keep forever. Scottish Mortgage is an investment trust, which helps because it does have quite a lot of unquoted stuff, but this is the appropriate investment vehicle for the unquoted stuff. It's a global investment trust, and it's like, well, it's the big boys, Amazon. I mean, that is a big company. I don't actually know what it is. Alibaba, Tencent, Tesla, Kering, Ferrari, Netflix, other big companies. It's had a phenomenal performance recently, as you can see by the chart. What was it? 110 years ago, 500, over 500 today. But you know, you never know when these things might turn around and start doing badly. But I've got other stuff that should do better if this one starts doing badly. Marlborough Multicap, similar to Lowland, it's, as the name suggests, it's UK focused and multi-caps, so different size companies. It can hold big companies and small companies. But looking at the top 10, I don't recognise many of these names, and so I'm thinking maybe they're quite focused on smaller or mid-sized companies at the moment. Could be wrong. If I clicked into them, maybe. So if I clicked into them, let's see how big this company is. I think this has been in BlackRock smaller companies before, so I think it's quite a small company. Big Yellow Group. I think it's the box, the storage people, aren't they? Yeah, 1.85 billion. I think that's considered mid-cap, maybe. I don't know. I might talk out of my bum sometimes, say things that I don't really know. BlackRock Frontier. So frontier markets are kind of less developed than emerging markets. They're earlier on in the stage in their development, and it's a fairly high income, this one. I mean, it worries me a bit in terms of the income. It worries me a bit because the income is paid in euros. No, dollars. So I don't know why I said euros. Yeah, paid in dollars. So even if they keep their dividends flat or increase the dividends, that doesn't guarantee me a flat or increased dividend because the value of the pound could affect it. So I don't know. It's a bit of a that's a bit of a worry. But look, it's a really tiny holding for me. It's only 4 grand odd. It's not doing too well actually. 16% down. I think I forgot to mention earlier, lots of these Asian ones that I've got or emerging markets are doing well because I was opportunistic when they were having a bad time in 2000 and what year was it? Basically, I bought them on a really down point. I think it was somewhere in this region where I bought those ones. So having it up by a good percentage compared to my other ones that are down here or up by a small amount here doesn't necessarily say that one is better than the other. It can just say I did a better job at picking the timing of buying that trust compared to the other one. That's so this table here that tracks my portfolio can be a bit misleading when you look at this column here. I bet I've been talking for a long time. Oh, geography, right. So this, let's just have a quick, so if we look at the UK versus the non-UK, just so that I want to, UK, well, 60% UK, so I'll call it UK, that's definitely UK. Foreign, UK, foreign, very much UK, but, well, this is the thing, these two are UK, but actually most of their income is outside of the UK, so do I really count them? I don't know, let's count them anyway. So I've got about 63% in the UK and the rest is in global ones. Now one thing that does bother me about like buying and holding forever, by me holding these two, I've kind of taken a choice to myself and this one, they are me making a decision on going for a certain area of the world. Whereas things like Fundsmith, Scottish Mortgage, Murray International, the fund manager decides where in the world to go. So I'm not so keen on making decisions myself because my own judgment has proved in the past not to be great. So that's something that I'm thinking about. Okay, there's a little summary of the core of my portfolio, the blue bit. Tune in next time and I'll probably go through this bit. Alright, in a bit. That will be a much shorter video. How long have we been going? Oh god, it's longer than the last video. I was trying to make this one shorter. Okay, I think it was more coherent though, even though it was longer. Alright, see you next time.